Gold is more than just a shiny yellow metal. It is an idea. It is a story that has been told for thousands of years across every continent and culture. When you hold a piece of gold, you are holding something that kings and pharaohs once desired. You are touching an element that was born in the heart of a dying star, long before our planet even existed. This metal has started wars. It has financed empires. It has been a symbol of love. It has been a store of wealth. It has been a promise of security. Its journey from the depths of the earth to the palm of your hand is a remarkable tale of science. It is a tale of human effort. It is a tale of history itself. For something so simple, gold holds a very complex place in our world. This essay is your guide to understanding that world. We will not use complicated jargon or confusing financial theories. Instead, we will take a clear and direct path. Think of this as a 20-minute conversation about gold. We will start at the very beginning. We'll cover the basic facts about what gold is and where it comes from. We will explore why this particular metal captured the human imagination so completely. Resistance to tarnish, beautiful luster, rarity. It doesn't rust or decay. A Roman gold coin looks much the same today as it did 2,000 years ago. This permanence is key to its power. Why should you care about gold in our modern age of digital money and complex financial systems? The answer is simple. The world is an uncertain place. Currencies can lose their value. Stock markets can crash. But gold has held its value through centuries of turmoil. It is a form of money that no government can print more of. It is a safe haven when other assets seem risky. Understanding gold is not just an academic exercise. It's a practical tool for protecting your wealth and navigating the economic landscape. It is a story about money, power, and survival. Our journey will be straightforward. We will cover everything you need to know in a short amount of time. First, origins of gold. Second, how it is mined from the ground. Third, turned into pure bars and coins. Then we'll follow that gold into the global market. We'll see how its price is set and what makes it go up or down. Finally, how ordinary people can own gold and the role it can play in their financial lives. This is your roadmap to understanding one of the world's oldest and most important assets. By the end, you will see gold not as a mystery, but as a clear and understandable part of the world's financial story. This guide is designed to be a quick but thorough exploration. We will break down the complex world of gold into simple, digestible parts. Our first stop will be the very beginning, the Earth itself. We will look at the geology of gold, how it's found in the planet's crust. We will then journey with the miners who extract it, the process of mining, digging deep underground, and sifting through riverbeds. Raw ore often contains only a tiny amount of gold. That ore is transformed through refining. The result, 99.99% pure gold used in global finance. It's a fascinating industrial process made easy to grasp. Once refined, gold's journey continues into the global marketplace. Here, gold shifts from physical metal into a financial asset. We will trace its path into the vaults of central banks. Central banks hold thousands of tons as national reserves. We will show how gold is made into coins. We will show how gold is made into bars. We'll demystify gold ETFs, exchange-traded funds. We'll demystify futures contracts. You'll learn the difference between owning physical gold and owning a paper claim to gold and why it matters. We'll make the market feel less intimidating and more accessible. No discussion of gold is complete without talking about its price. What makes the price move every single day? We'll explore supply and demand, supply, mining, supply, recycling, demand, jewelry, demand technology, demand investors, demand central banks. We'll use real-world examples, economic crises, example, inflation fears, example, changes in government policy. By understanding these drivers, You'll read financial news with confidence. The price reflects global economic health and human psychology. Finally, we bring the story home to you, the individual. What does gold mean for your personal finances? Options: buying small coins. Options: investing in gold-focused funds. We'll cover pros and cons in plain terms. Topics: storage. Topics: security. Topics: insurance. Crucially, we'll talk about the risks. Gold is not a get-rich-quick scheme. Its price can be volatile and requires careful consideration. Our goal: give you knowledge to make informed decisions. Ending: actionable steps and a balanced perspective on gold's enduring role. Gold's story does not begin on Earth. It begins in the vast, violent emptiness of space. The gold atoms in a wedding ring. Coin. They were forged billions of years ago inside colossal, dying stars. When a massive star runs out of fuel, it can collapse, and then explode in a cataclysmic event called a supernova. The immense energy and pressure in these explosions fuse simpler elements together, creating heavier ones, like gold. For a brief, brilliant moment, a star's death becomes a cosmic factory. These newly created elements are scattered across space as cosmic dust. Gravity eventually pulled clouds of this dust and gas together to form new stars, planets. Our solar system, including Earth, was born from such a cloud about 4.5 billion years ago. In its early, molten state, heavier elements sank toward the planet's core: iron, gold. The vast majority of Earth's gold is locked deep within its center, inaccessible. If all that core gold were brought to the surface, it would coat the planet 4 meters thick. The gold we can reach is therefore incredibly rare. How did any gold end up in the crust where we can find it? The answer comes from space. During the late heavy bombardment about 4 billion years ago, the young Earth was pummeled by asteroids. These asteroids were rich in heavy elements. As they crashed, they delivered gold, other metals. This is the gold humanity has mined for millennia. It's a finite, precious veneer of cosmic treasure deposited long after Earth's formation. This cosmic origin explains gold's value. It is not just rare, it is finite. Unlike paper money, digital entries, we cannot create more of it. Every ounce that has ever been mined or will be mined already exists on Earth. That fixed supply, from stars and geology, gives gold intrinsic scarcity. When you hold a piece of gold, you hold a fragment of an ancient, exploded star. That physical reality underpins its economic and cultural significance through history. Gold is scattered across the globe in incredibly small concentrations. Finding it is a monumental challenge. The first gold discoveries were likely made in rivers and streams. Over millions of years, the forces of erosion, wind, rain, ice, wore down mountains and rocks that contained gold veins. As the rock crumbled, tiny flecks and nuggets of gold were washed away by water. Because gold is extremely dense, about 19 times heavier than water, it quickly settled at the bottom of riverbeds. Early humans would have noticed these shiny yellow stones while gathering water or fishing. This type of gold deposit is called a placer deposit, and it was the source of all ancient gold. The earliest mining was simple. People would use shallow pans to scoop up sand and gravel from a riverbed. By swirling the pan with water, the lighter materials like sand, mud, and pebbles would wash over the edge. The heavy gold, however, would remain at the bottom. This technique, known as panning, is still used today by prospectors and hobbyists. But it is not efficient for large-scale production. Over time, more sophisticated methods like sluice boxes were developed. A sluice is a long, sloping trough with barriers along the bottom. River gravel is washed through it. The heavy gold gets trapped behind the barriers. The lighter material flows away. While river gold was easiest to find, its supply was limited. To get more, miners had to go to the source, the primary or lode deposits. These are the veins of gold still embedded within solid rock, deep underground. These veins were formed when superheated water, rich in dissolved minerals, flowed through cracks in the Earth's crust. As the water cooled, it deposited minerals, including gold, into the fissures, creating streaks of precious metal within the host rock. Finding these lode deposits is far more difficult than finding placer gold. It requires extensive geological knowledge, surveying, and often a bit of luck to locate a vein that is rich enough to be worth mining. Modern exploration uses advanced technology to find these hidden treasures. Geologists study rock formations and geological maps to identify promising areas. They take soil samples and rock samples to be analyzed for trace amounts of gold. Sophisticated techniques like aerial surveys using radar or magnetic sensors can help map underground structures. Drilling is the final test. A drilling rig extracts long, cylindrical cores of rock from deep within the earth. These cores are then carefully examined by geologists. If they show sufficient concentrations of gold, the massive and expensive process of establishing a mine can finally begin, marking the transition from exploration to extraction. Section 3. The Miner's World, a story of toil. Imagine a man named Kofi, a small-scale miner in Ghana. His day begins before dawn. He walks for miles. He arrives at a patch of land, a narrow, unstable shaft in the red earth. He descends into the darkness, a rope, a headlamp, a pickaxe. The air is hot. The air is thick. The air is heavy with dust. He spends hours chipping at a quartz vein, hoping for the yellow glint of gold. The work is physically punishing, extremely dangerous. The risk of a tunnel collapse is constant. For every small fragment of gold, he moves tons of worthless rock by hand. This scene repeats millions of times around the world. Large industrial operations, small artisanal pits, immense human effort. Modern open-pit mines are mechanized and dramatic. Terraced mine from above, huge haul trucks moving rock, tires taller than a person, controlled explosives blasting the rock face, colossal shovels scooping rubble. Mines can be miles wide. They operate 24 hours a day. The goal, same as Kofi's, move enormous quantities of earth, extract a tiny amount of precious metal. 1 ton of ore yields only a few grams of gold. Underground mining is even more challenging. Miners descend into a network of tunnels that can run miles below the surface. The deepest gold mine in South Africa, nearly 2.5 miles deep. Rock temperatures can exceed 140 degrees, 60 degrees C. Massive refrigeration and ventilation systems keep it survivable. Miners in cramped, dark spaces operating heavy drill machinery. Bringing ore up is a major logistical operation. Underground trains, massive hoist systems. A high-tech, high-risk industrial environment. The life of a miner, industrial or artisanal, is hard work and hope. It is a gamble. Kofi might work weeks and find very little. A corporation might spend hundreds of millions and still come up short. Yet the allure of gold keeps them going. For Kofi, a find could mean feeding his family for a year, or sending his children to school. For a large company, it means profits for shareholders. In both cases, the human story is pursuing a rare prize against incredible odds, driven by a timeless human desire. Section 4. From ore to ingot, the magic of refining. Once the gold-bearing ore is brought up from the mine, the next challenge begins. The gold is still locked inside the rock, often in microscopic particles invisible to the naked eye. Separating these tiny specks from tons of waste is a feat of modern chemistry and engineering. The first step is crushing and grinding. The ore is fed into a series of giant crushers and rotating mills. These machines often contain large steel balls. They pulverize the rock into a fine powder, almost like sand or flour. This is called comminution. Its purpose is to increase the ore's surface area, exposing the gold particles for the next stage. With the ore ground fine, the gold can now be chemically extracted. The most common method, used for over a century, is cyanidation. The powdered ore is mixed with a weak sodium cyanide solution in large agitated tanks. The cyanide dissolves the gold, forming a water-soluble gold cyanide compound. The gold is now held in the liquid solution rather than as solid particles. Cyanidation can extract over 95% of the gold. However, cyanide is highly toxic, so operations must follow strict environmental protocols to manage and neutralize it. After dissolution, the gold must be recovered. The most common technique is carbon in pulp. Small granules of activated carbon are added to the solution. Gold adsorbs onto the carbon granule's surface. After several hours, the gold-laden carbon is separated from the barren slurry using screens. The carbon is transferred to another vessel and washed with a hot, caustic cyanide solution. This strips the gold from the carbon, creating a concentrated gold solution. The final step is turning the dissolved gold back into solid metal. This is done by electrowinning. The concentrated solution is passed through cells using electric current. Gold deposits onto a steel wool cathode. The cathode, coated with gold sludge, is removed and treated with acid to dissolve the steel wool, leaving high-purity gold sludge. The sludge is dried and mixed with fluxes to remove remaining impurities. The mixture is ready for the final fiery transformation into a nearly pure gold bar. Section 5. The first transformation, a bar is born. The journey from a speck of cosmic dust to a tangible asset reaches its climax in the smelter. The gold sludge, recovered from the chemical process, is placed into a crucible, a special pot designed to withstand extreme temperatures. The crucible is heated in a furnace to over 2,100 degrees Fahrenheit, 1,150 degrees Celsius. At this intense heat, the gold and the added fluxes melt into a glowing molten liquid. The purpose of the fluxes is to bind with the remaining impurities in the sludge, such as silver, copper, or zinc. These impurities, combined with the fluxes, form a lighter liquid layer called slag, which floats on top of the much denser molten gold. This fiery purification is a dramatic sight. The smelter carefully tilts the crucible, pouring off the molten slag to be discarded. What remains is a shimmering, almost pure liquid gold. The next step is the pour. The molten gold is poured into a cast iron or graphite mold, which is typically shaped like a brick. As the liquid gold fills the mold, it begins to cool rapidly from the outside in. The surface quickly solidifies, trapping a beautiful, radiating pattern on the top of the bar as the last of the metal cools. Within minutes, the liquid has transformed back into a solid, but now it is no longer ore. It is a bar of gold. This newly created bar is called a doré bar. The name comes from the French word for gilded or golden. It is not yet pure gold, but is typically between 60% and 95% pure gold, with the remainder being mostly silver and other trace metals. The doré bar is the primary product of a gold mine. It is solid, transportable, and valuable enough to be shipped securely from the mine site to a specialized refinery. Mines do not typically produce 99.99% pure gold on site. Their job is to get the gold out of the ground and concentrate it into a doré bar, which represents the first tangible, consolidated form of the wealth they have extracted. From the mine, these doré bars begin the next leg of their journey. They are transported under high security to one of a handful of accredited precious metals refineries located around the world, in places like Switzerland, London, or Singapore. At the refinery, the gold will undergo a final, even more precise purification process to remove the last remaining impurities. This final refining will raise its purity to the good delivery standard of 99.5% or higher, which is required for it to be traded on international bullion markets. The rough bar from the mine is about to become the standardized financial asset that underpins global commerce. The journey of gold from the mine's rough doré bar to the global market requires one final crucial step: final refining. Doré bars arrive at highly secure, specialized refineries, many of which are in Switzerland. Here, they undergo advanced processes to achieve ultimate purity. One common method is the Wohlwill process, which uses electrolysis to dissolve the gold bar into a solution, and then redeposit it as pure 99.99% gold, leaving impurities like silver behind. Another method, the Miller process, uses chlorine gas to separate other metals at high temperatures. The result of this meticulous purification is gold that is pure enough to be accepted by any major financial market in the world. This is the gold of international finance. This highly refined gold is then cast into a very specific form, the London Good Delivery Bar. This is not just any bar of gold. It is the global standard for large-scale gold trading. A good delivery bar has strict specifications set by the London Bullion Market Association. It must have a minimum purity of 99.5% gold. It must weigh between 350 and 430 troy ounces, approximately 11 to 13 kilograms. Each bar is stamped with a unique serial number, the refinery's hallmark, its purity, and the year it was made. These bars are the interchangeable, fungible units that form the bedrock of the professional gold market, like the large denomination bills of the global financial system. Why is this standardization so important? It creates trust and efficiency. When a bank or a government wants to buy a large quantity of gold, they need to know that what they are receiving is authentic and of a guaranteed quality, without having to test every single bar. The LBMA maintains a good delivery list of accredited refineries whose bars are accepted without question. This system allows for the seamless transfer of vast amounts of wealth between institutions. A trader in London can buy gold stored in a vault in Zurich, and a central bank in Asia can sell gold held in New York, all with complete confidence in the product they are trading, sight unseen. These large bars are the primary way gold is held in the official sector by central banks and large financial institutions. They are stored in enormous, highly secure vaults, located in major financial centers like London, New York, and Zurich. The gold you hear about on the news, the gold held by the U.S. Treasury at Fort Knox or by the Bank of England, is held in this form. These bars rarely move. Instead, ownership is transferred electronically on a ledger. One institution's account is debited and another's is credited, while the physical bars may stay in the exact same spot on the same shelf in the same vault. This is the hidden wholesale market where gold truly functions as money. The price of gold, which you see quoted every second of the trading day, is determined by the constant interplay of supply and demand. It is like a global auction happening in real time. On the supply side, there are two main sources. The first is new gold coming from mines around the world. Every year, mines produce roughly 3,500 metric tons of gold. This new supply is relatively stable and predictable, as opening a new mine takes many years. The second source is recycled gold. This includes old jewelry, industrial scrap, and gold recovered from old electronics. When the price of gold is high, it encourages more people to sell their old gold items for cash, increasing the recycled supply. On the demand side, the picture is much more diverse and dynamic. Graph: a breakdown of global gold demand by sector: jewelry, investment, central banks, and technology. The largest single source of demand is for jewelry, which accounts for about half of all gold demand each year. China, India. The next major source is investment demand: individuals and institutions buying gold bars and coins. Financial products like gold-backed exchange-traded funds. This type of demand often rises during times of economic uncertainty, as investors seek a safe haven for their money. Gold's price often goes up when people are worried about the economy. Another crucial player on the demand side is central banks. For decades, central banks were net sellers of gold, but that trend dramatically reversed after the 2008 financial crisis. Today, central banks around the world are significant net buyers of gold. They add gold to their official reserves to diversify their assets away from the US dollar and to provide a store of value that is not tied to any single country's economy. The buying or selling actions of these massive institutions can have a powerful impact on the global gold price. A final source of demand comes from technology, where gold is used in small amounts in high-end electronics due to its excellent conductivity and resistance to corrosion. The price you see is set primarily in two major global hubs, London and New York. The London market is an over-the-counter market where large institutions trade physical gold directly with each other, with the price being set twice daily through an electronic auction. The New York market, centered on the COMEX exchange, is a futures market where traders buy and sell contracts for the future delivery of gold. The constant trading in these two centers, driven by news, economic data, and investor sentiment, creates the continuous stream of price information that we know as the spot price of gold. It is a global conversation about risk, value, and the future of money. Section 4. The investor's gold, coins, bars, and ETFs. While central banks trade in 400-ounce bars, gold is accessible to everyday investors in much smaller, more manageable forms. The most traditional way to own gold is by buying physical coins and bars. Gold coins are produced by government mints around the world and are a popular choice for new investors. Famous examples include the American Gold Eagle, Canadian Maple Leaf, South African Krugerrand, and Austrian Philharmonic. These coins are legal tender in their country of origin, which can provide an extra layer of authenticity. They are typically sold in various sizes, from 1 full troy ounce down to smaller fractions, like 1/10 of an ounce. For those looking to buy larger quantities of physical gold, bars are often a more cost-effective option. Gold bars are produced by private refineries and government mints. Sizes range from tiny 1-gram bars to 1-kilogram bars. The key advantage of bars is a lower premium over the spot price of gold compared to coins. A premium is the extra cost you pay for manufacturing, distribution, and the dealer's profit. Because it is cheaper to produce a single 1-ounce bar than a 1-ounce coin, bars can be a more efficient way to accumulate gold by weight. In the modern era, a new and extremely popular way to invest in gold has emerged, the Gold Exchange Traded Fund, or ETF. An ETF is a fund that trades on a stock exchange, just like a share in a company. A gold ETF, however, does not represent ownership in a company. It represents ownership of gold. The company that manages the ETF buys and stores large quantities of physical gold bars in a secure vault. It then issues shares that track the price of gold. When you buy a share of a gold ETF, you are buying a claim on a small fraction of the gold held in that vault. This made investing in gold as easy as logging into a brokerage account and buying a stock. Gold ETFs offer several major advantages. They are highly liquid, meaning you can buy and sell them instantly throughout the trading day at a price very close to the spot price of gold. They also solve the problems of storage and security that come with owning physical metal. You don't have to worry about buying a safe or paying for insured storage. However, there is a crucial trade-off. When you own an ETF, you do not own the physical gold itself. You own a financial security, a paper claim on the gold. For many investors, this is a convenient and acceptable compromise. But for others, the old saying holds true. If you don't hold it, you don't own it. Section 5. Futures and paper gold, the digital marketplace. Beyond physical ownership and ETFs, there is another massive layer to the gold market, the world of futures and derivatives. This is often called the paper gold market because the volume traded here far exceeds physical gold changing hands. A futures contract is an agreement to buy or sell a specific amount of gold at a predetermined price on a future date. These contracts are standardized and traded on regulated exchanges, most importantly the COMEX in New York. A standard COMEX gold futures contract represents 100 troy ounces of gold. The primary purpose of the futures market is not physical delivery. Instead, it is used for hedging and speculation. A gold mining company might sell futures contracts to lock in a price for future production and protect against price falls. A jewelry manufacturer might buy futures contracts to lock in the cost of gold for upcoming production. Speculators use futures to bet on the gold price's direction. They can buy contracts if they think the price will rise, or sell them short if they think it will fall, all without touching a single ounce of gold. Trading in this paper market hugely influences the global spot price. Because of leverage, traders put down a small percentage as collateral. Enormous positions can be controlled with little capital. This can lead to rapid, significant price movements. A large hedge fund buying thousands of contracts or selling thousands of contracts can swing the price in minutes. Many analysts say price discovery now happens more in New York's paper market than in London's physical market. This creates a controversial dynamic. Well over 99% of futures contracts are closed out or rolled over before delivery. They are settled in cash. Only a tiny fraction results in actual delivery of physical gold bars from COMEX warehouses. This has led to debate over the system's stability. Some worry that if many holders demanded physical delivery suddenly, there wouldn't be enough gold in warehouses to satisfy claims. Regardless, the futures market remains essential, if complex, driving liquidity and influencing price for everyone. Section 1. The physical choice. Why hold it in your hand? For many people, the only true way to own gold is to hold it physically. This means buying gold coins or gold bars that you can see and touch. The appeal of physical gold is deep and primal. It is a tangible asset. In a world of digital accounts and complex financial instruments, a gold coin is simple and real. It has no counterparty risk. This is a crucial concept. When you own a share of a stock or a bond, your investment depends on the performance and solvency of another party, whether it's a company or a government. A physical gold bar sitting in your safe depends on nothing but itself. It cannot go bankrupt. It cannot be erased by a computer glitch. This independence is its core strength. Owning physical gold provides a unique sense of security and finality. It is a form of wealth that exists completely outside of the digital financial system. In a severe crisis, if banks were to close or electronic payment systems were to fail, the gold in your possession would still be valuable. It is a form of emergency money that has been trusted for millennia. This is why some people refer to it as calamity insurance. They do not own it with the expectation of getting rich quickly. They own it as a last line of defense against unforeseen economic or political turmoil. It is a permanent store of value that can be passed down through generations. There are, however, practical downsides to owning physical gold. The first is the cost. Buying physical gold always involves paying a premium over the spot price. This premium covers the cost of manufacturing the coin or bar, as well as the dealer's profit margin. The second challenge is storage. You need a secure place to keep your gold. A small amount might be hidden at home, but for larger quantities, you may need a bank-safe deposit box or specialized private vault storage. This adds another layer of cost and complexity. Storing gold at home carries the risk of theft, while storing it elsewhere means you do not have immediate access to it. Finally, physical gold is not as liquid as a financial asset like a stock. To sell it, you must find a reputable dealer, transport the gold, and have it verified. While the market for gold is very deep and you will always be able to sell it, the process is not as simple as clicking a button in a brokerage account. You will also likely sell it for slightly less than the current spot price, as the dealer needs a margin to profit. These trade-offs, higher costs, storage challenges, and lower liquidity, are the price you pay for the ultimate security of holding a real, tangible asset in your own possession. Once you decide to buy physical gold, your next step is to find a reputable dealer. This is a critical choice. The world of precious metals has its share of untrustworthy sellers who may overcharge or sell counterfeit products. A good dealer will be transparent about their pricing and have a long-standing reputation. You can find them online or in local brick-and-mortar coin shops. Look for dealers who are members of industry organizations like the American Numismatic Association or Professional Numismatists Guild. These organizations have strict codes of ethics, giving you an added layer of protection and confidence. When you go to buy gold, you'll notice the price is always higher than the spot price you see on the news. This additional cost is called the premium. The premium is not a hidden fee, it's a necessary part of the business. It covers fabrication, turning raw gold into coins or bars. It covers dealer overhead. It covers rent. It covers security. It covers staff. And it covers the dealer's profit margin. The size of the premium can vary significantly. Smaller items tend to carry much higher premiums by percentage. 1 gram bar, 1/10 ounce coin, versus a larger 1 ounce bar, because fixed manufacturing costs are spread over more gold. The type of product also affects the premium. Newly minted government coins often carry higher premiums. American Gold Eagle, example. Standard gold bars of the same weight usually have lower premiums. Coins can have numismatic or collectible value beyond their metal content. Coins are more recognizable and easier to resell. Plain gold bars from accredited refiners are typically the most cost-effective by weight. For pure gold bullion investment, many buyers prefer bars to maximize gold per dollar. When you purchase from a dealer, the process is straightforward. You agree on a price, usually locked in at the transaction. Because the spot price is always moving. You will then need to pay, often via bank wire or by check for larger purchases. Avoid credit card payments. Fees add to cost. The dealer will either hand you the gold in-store or ship it via a secure, insured courier. Always confirm shipping is fully insured until it reaches your hands. A good dealer ensures a smooth, secure process, making buying the world's oldest money feel safe and professional. After you have purchased your physical gold, you face an immediate and important question. Where will you keep it? The decision of how to store your gold involves a careful balance of security, access, and cost. There are 3 primary options, each with its own advantages and disadvantages. The first and most obvious option is home storage. This gives you direct, immediate control over your asset. You can access it 24/7 without needing permission from anyone. For small amounts, this can be a viable strategy. However, it also carries the significant risk of theft. A simple hiding place is often not enough, and a high-quality, heavy-duty safe is a wise investment, though that adds to the overall cost. A second popular option is to use a bank-safe deposit box. This offers a higher level of security than most homes can provide. Banks have vaults, alarms, and guards. The cost is also relatively low, typically an annual fee of about $100, depending on the box size. However, there are crucial downsides. Your access is limited to the bank's operating hours. More importantly, the contents of a safe deposit box are not insured by the FDIC or the bank itself. If the bank is robbed, or there is a fire, or a flood, you could lose your holdings. You could protect yourself with a separate private insurance policy, but that can be difficult to obtain for safe deposit box assets. The third and increasingly popular option for larger holdings is a private, non-bank vault. These are specialized facilities designed exclusively for storing precious metals and other valuables. They offer security that is often superior to that of banks, with state-of-the-art surveillance and strict access protocols. A key advantage is that the gold stored in these vaults is often fully insured, and it is held on a segregated and allocated basis. That means your specific bars or coins are set aside under your name, not just pooled with other clients' assets. This provides a high degree of confidence that your gold is truly yours and is protected. This premium security, however, comes at a higher cost. Private vaulting fees are typically calculated as a percentage of the value of the assets, often ranging from 0.5% to 1.5% per year. That can become a significant ongoing expense for a large holding. Furthermore, like a bank, your access is limited to the facility's hours and location. For investors who want the security of physical gold without the personal risk of home storage and with more legal protection than a bank box, private vaults represent the gold standard of storage. The choice ultimately depends on your personal risk tolerance, the amount of gold you own, and how you prioritize security versus cost and accessibility. For many investors, the challenges of storing and securing physical gold are a significant barrier. In response, the financial industry has created modern alternatives that offer exposure to the price of gold without the need to handle the metal itself. The most popular of these is the Gold Exchange Traded Fund, or ETF. When you buy a share of a gold ETF like GLD or IAU, you are buying a security that tracks the price of gold. The fund's operator holds large physical gold bars in a secure vault, and each share represents a small claim on that underlying gold. This makes investing in gold as easy as buying a stock through a standard brokerage account. The advantages of ETFs are compelling. They are extremely liquid, allowing you to buy and sell instantly during market hours. Transaction costs are very low, often just a standard brokerage commission, and the premium over the spot price is minimal. Annual management fees are also quite low, typically less than 0.5% per year, often cheaper than insured private storage for physical metal. ETFs solve storage and security problems for the individual investor. You do not need to worry about buying a safe or finding a dealer. Convenience and simplicity have made ETFs the go-to choice for millions worldwide. However, it is crucial to understand what you are owning. With a gold ETF, you do not own the gold. You own a financial instrument, a paper promise backed by gold. You are a shareholder in a trust, and that trust owns the gold. While major ETFs are reputable and audited, you are still exposed to counterparty risk. You are trusting the fund's management, the custodian vaulting the gold, and the entire financial infrastructure to honor your claim. You cannot show up at the vault and ask for your share of the gold. Redemption for physical metal is typically only possible for very large, institutional-sized blocks of shares. For purists, this layer between them and the metal is an unacceptable risk. Another form of paper gold is the certificate program. Offered by mints or banks, these programs allow you to buy gold that is stored for you in their vaults. You receive a certificate of ownership. This can be a good option if the gold is allocated, meaning specific bars are registered in your name. There is also unallocated gold, where you are simply a creditor to the institution which owes you a certain amount of gold from a general pool. Unallocated gold carries more risk, as you depend on the institution's solvency. These modern alternatives offer convenience, but they reintroduce the counterparty risk that physical gold ownership aims to eliminate. So, what is the right way to think about gold in the context of your overall financial life? For most people, gold should not be treated as a get-rich-quick investment. Its price can be volatile in the short term. Instead, financial advisors often recommend viewing gold as a tool for diversification and risk management. A well-diversified investment portfolio typically contains a mix of assets: stocks, bonds, real estate, gold, a small slice, 5 to 10%. Stocks provide the potential for growth. Bonds provide income and stability. Gold plays a different role. Its value often moves independently of stocks and bonds. It tends to perform well when other assets are struggling. Think of it as portfolio insurance. During periods of economic stress, stock markets can fall sharply. Central banks may lower interest rates. Central banks may print money to stimulate the economy. That can devalue currencies and hurt bond prices. Investors often flock to the safety of gold, pushing its price up. By holding a small portion of your portfolio in gold, you create a buffer. A rise in your gold holding can help offset losses in stocks. That smooths overall returns and reduces volatility. It is a stabilizing force in uncertain times. How much gold should you own? Opinions vary among financial experts. A common recommendation: allocate 5 to 10% of investable assets to gold. Close-up. This allocation gives diversification benefit without excessive risk. It won't make you rich if gold soars, but it can provide crucial protection if other investments falter. See gold as protection, not your primary growth engine. Ultimately, owning gold is a personal decision tied to your goals and worldview. Convenience of paper assets, absolute security of physical metal. Consider a timeless store of value in a modern digital economy. Buy a single gold coin, a few shares in an ETF, nothing at all. Understanding gold's unique properties and its role in the financial system is valuable. It empowers you to make more informed choices to protect and grow wealth over the long term. We began our 20-minute journey with a simple, powerful idea. Gold is more than just a metal. It is a story. We have now traveled the full length of that story, from its violent birth in the heart of an exploding star to its final resting place in a central bank vault or an investor's safe. We saw how cosmic dust formed our planet and how geological forces concentrated it into veins of rock. This astronomical origin story is not just trivia. It is the source of gold's most fundamental quality: absolute scarcity. No government can print it, no alchemist can create it. Its supply is finite, a physical reality that underpins its value. From there, we followed the human struggle to claim this treasure from the earth. We witnessed the toil of the miner in a small, artisanal pit in Ghana and in a vast, mechanized mine in Nevada. Extraction is immense effort, moving mountains of rock for grams of metal. We demystified the industrial magic of refining, where cyanidation and chemistry transform raw ore into doré bars. That first transformation sends gold from geology into commerce, ready for the global financial system. From raw commodity to a highly refined financial asset. We then entered the intricate gold market. Rough doré bars are purified to 99.99% and cast into London good delivery bars. We explored the great vaults of New York and London, where national wealth is stored and ownership often transfers electronically without bars moving. We untangled supply and demand driving the daily price, from jewelry demand in India to strategic central bank buying away from the US dollar. We peeked into paper gold on COMEX, where futures trading volumes influence the spot price. Finally, we brought the story personal. Investor choices. Physical gold coins, physical bars, versus exchange-traded funds. Find a reputable dealer and know the premium over spot. Storage is crucial. Home storage, bank-safe deposit boxes, specialized private vaults. Through it all, clarity, turning complexity into clear concepts and choices you can act on. Understanding gold is one thing. Deciding what to do with that knowledge is the next logical step. Define goals. Research dealers, ETFs. Decide allocation. Start small. First action. Define your purpose. Why are you buying gold? Long-term wealth preservation. Calamity insurance. If long-term, consider physical ownership. Coins. Or physical ownership, bars. Note, physical comes with higher costs and storage considerations. If you're seeking a liquid short-term hedge, consider a gold ETF. ETFs offer convenience and low cost, and they're easily managed in your existing brokerage account. Once you know your why, educate yourself on the how. Start by researching reputable local dealers, and research reputable online dealers. Compare premiums on popular 1-ounce products. American Gold Eagle 1-ounce coin. Pamp Suisse 1-ounce gold bar. Understand the cost differences and pick what fits your budget. If you go the paper route, research major gold ETFs. Look at GLD, look at IAU, check their expense ratios, check annual fees, Check trading volumes. A little research now can save you a lot over the long term. Third step, determine your allocation. Many advisors suggest a modest allocation, typically 5 to 10%. Calculate what a 5% allocation means in dollars. Does this amount feel comfortable? Start smaller if you're uncertain. You can add more over time. Finally, the most important step is to start small. Use a strategy called dollar cost averaging. Buy a fixed dollar amount on a regular schedule, monthly, quarterly. This smooths your purchase price and avoids the risk of buying a large sum before a price drop. Start with a single 1/10 ounce gold coin, or buy a few shares of an ETF. It makes the process real and turns abstract knowledge into tangible action. As our journey concludes, we are left with a final, forward-looking question. What is gold's role in the 21st century and beyond? In an age of cryptocurrencies, central bank digital currencies, and instantaneous global payments, it can be tempting to view a heavy, inert metal as an anachronism, a relic of a bygone era. Skeptics argue that gold's only value is based on belief and tradition, and that newer, more technologically advanced assets will inevitably supplant it. They point to its lack of yield. It pays no interest or dividends as a fundamental flaw in a modern investment portfolio. From this perspective, gold is simply a piece of history, not a part of our financial future. However, the case for gold's continued relevance is equally, if not more, compelling. The very attributes that make gold seem archaic are also the sources of its greatest strengths. Its physical nature makes it immune to hacking and digital erasure. Its lack of reliance on any government or financial institution gives it a unique status as a truly neutral store of value. As global debt levels reach unprecedented heights and central banks engage in ever larger monetary experiments, gold's discipline as a finite asset becomes more attractive, not less. It is precisely because it is not part of the modern digital system that it serves as the ultimate insurance policy against the failure of that system. The rise of digital assets like Bitcoin, often called digital gold, does not necessarily mean the demise of physical gold. Split image. Instead, it may simply highlight the growing demand for assets that exist outside of traditional government control. The two can coexist, serving different needs. Gold has a 5,000-year track record of preserving wealth through every imaginable crisis. No new technology can replicate overnight. It has proven its resilience through empires, wars, and currency collapses. Central banks, the ultimate long-term investors, continue to be major buyers of gold, signaling their belief in its enduring role as a foundational monetary asset for the global system. Ultimately, gold's future will be determined by the same factor that has defined its past: trust. As long as humans seek an honest and enduring store of value, gold will have a place. It is the final arbiter of value, the bedrock of the financial system that only becomes visible when the ground begins to shake. Its story, which began in the stars and wound its way through human history, is far from over. It remains a silent, gleaming testament to the timeless search for permanence in an uncertain world. Your understanding of this journey now equips you to decide what part this ancient, noble metal will play in your own financial future.